Hey everybody, we just entered the last trading day of 2023. So to commemorate that, we're going to look at 10 of the best performing stocks in the entire stock market throughout this year. If you like this kind of content, be sure to give this video a big thumbs up. Helps a ton with the channel. Consider subscribing to the channel as well. But we're just going to jump right into this because we have a lot to cover. So as you can see on the screen, the first stock that had an unbelievable 2023 is Chipotle Mexican Grill. This is a quick service restaurant operating increasingly around the world, but primarily in North America. You can see this stock, pretty boring industry that they operate in, and they already were trading at a pretty expensive price to earnings entering the year, but they went up 62% this year. Phenomenal chart. You can see pretty much up and to the right, a couple specific jumps that they had, but they're currently right around a 52-week high and an all-time high on the year just here in December. Even over the last 5 years, this one's just gone crazy, up 400%. So not necessarily a surprise in terms of the trend, but lots of people just didn't think this company can keep on compounding at this 50% plus CAGR. Let's take a look at some of their results from throughout the year. So in the third quarter alone, the company has double-digit revenue increase despite increasing their absolute store count by quite a bit. They're continuing to see pretty good comp sales, same-store sales growth as well, about 5% up on the quarter. They're seeing margins go up, operating margins up 16%, up from 15%, and then what restaurant margins to 26%, 100 basis point help there. So you can see this all equated to their EPS going up 23%, to $11.30 on the quarter, up from just $9 a year ago. So on a total basis, I look at that $11 a quarter. If I was to annualize that, it would be $40 to $50, and you're paying over $2,200 a share. So definitely super expensive business here, but they're expanding really quickly. You can see in the quarter, the last quarter, they opened 62 restaurants. So that's almost a restaurant a day. It's about 2 restaurants every 3 days they're opening around the world. And I expect that rate to continue just as this model has kind of been proven out at this point. And they're very underpenetrated versus lots of other quick service restaurants with the popularity of Chipotle. Another look at Chipotle here is they continue to invest in ways to make their kitchens and restaurants more efficient. One thing they've been very vocal about is robotics in and out of the kitchen, just to help their business run more efficiently, quicker. They have big rushes around lunch and dinner time, help their staff better prepare and have better quality assurance for those times of the day. And also maybe longer term, this could be a cost savings initiative, not just an efficiency and a productivity thing as well. As maybe less and less people want to be doing these types of jobs, they will be less at the mercy of staff shortages and that impacting the business at all. So I like that they're also kind of at the forefront of lots of the future trends in the quick service restaurant industry as well. With that being said, like we said, this one's trading at a huge multiple, 54 times trailing. On a forward-looking basis, probably closer to 40 times, 42, 43. So really high multiple to pay for a restaurant company. But if there is one that's worth it paying on it, especially given the track record, it may be Chipotle here. Going into stock number 2, Shopify. Shopify here up over 110% on the year. $130 billion Canadian market cap on this, about $100 billion US. Looking at this one over the last 5 years, it's had some volatility to it. This is obviously a name given the presence of e-commerce and entrepreneurship and stuff like that. Just exploded during the pandemic, up to $200 a share, giving it a market cap of about $250 billion. And it's bounced back since it hit its lows last year in 2022, going into 2023. And then we just really see that steady climb up throughout the year to this point where in the last month or two, it's exploded up to $100 a share. So $100 a share is about 50% higher than this thing was trading at its peak before the pandemic here in February 2022 of about $68 a share. And it's looking at some elements of their business from a fundamental standpoint. Revenue up 25% on the quarter, almost $2 billion in revenue per quarter now on this one. So if I annualize that, they're at about $6 to $7 billion a year. Still pretty expensive for that valuation of $130 billion, but lots of this is high gross margin business that they're getting here. They're about a 10% market share in the US e-commerce landscape. So that's nice that they're continuing to carve out a really nice niche of that. They're continuing to expand their presence in different markets, 175 different countries there. And then in addition to geographical expansion, look at the different types of businesses that they're rolling out and benefits to both consumers as well as vendors and businesses. And this is just enabling them to get more and more fee revenue and different kind of affiliated revenue in different ways by partnering with all of these different types of stakeholders across their value chain here. So you can see over the years all the different things that they've innovated, brought to market. I think lots of those add-on services is a big reason why this one's up 500% in the last 5 years, but about 120% in the last year, and year to date about that as well in 2023. Third stock here, Netflix. Netflix year to date on this one up 70%, whereas the rest of the media landscape, call it traditional media like Warner Brothers Discovery, Paramount Global, Disney, have all kind of had a bad year again. Netflix continues to disproportionately grow in terms of their relative performance and their relative size of company market cap wise to $215 billion. That's probably close to double what Disney is right now, and Disney is by far the biggest one other than them. So back up to $500 a share. This one too had a bit of a rocky road. Obviously blew up a bit with Squid Games and the pandemic and everything like that, but had a really big fall from grace to about $180 a share. Now we're right back up there to $500. Really nice valuation for this one. Also very close to a 52-week high on it. And at the end of the day, I know Netflix doesn't love when investors overvalue or overanalyze the subscribers numbers, but it's just really hard to ignore that Netflix added 9 million subscribers in the last quarter, and they also projected that they're going to add 9 million more in the fourth quarter, or at least that's what analysts think. And adding 18 million subscribers in 6 months just completely wipes out the narrative that they kind of hit critical mass on the amount of subscribers that they can add to their business. Now, lots of this may also be confirmation that them kind of doing password sharing limitations and whatnot has worked to grow the business. So however you want to cut it, they're just having a really strong growth year on users, which will pay dividends years to come as they flex their pricing power, as they introduce more advertising options, stuff like that. So this business is in a really good position, and it's increasingly looking like they're really going to be a big winner in the media and entertainment space. Next stock that had a great year here, Lululemon, up almost 60% here, $61 billion company here, huge trailing PE of about 60 times. Looking at their numbers here, you can see they have really good 2023 numbers. So in the last quarter, revenues increased about 20% there, 50% internationally. So investors are probably really liking the international story and the scale that they're trying to build out on a global basis. Same store or comparable sales, which is, I guess, similar to same store sales, up 13%. Same store sales directly up 9% there. And then direct to consumer increased almost 20%. So lots of really nice high double digit growth that they're seeing. They also saw their margins increase, gross margin here up 110 basis points of 57%. And when on an adjusted basis, 58%. Those are really great gross margins for a business like this with the amount of productivity they have. They're able to crank out a lot of free cash flow from that. And as we look at what they're doing with their free cash flow, they actually, continue to open up new stores. So up 14 company operated stores in the quarter, almost at 700 now. But they're also doing more and more buybacks. So they bought back about $210 million of shares in the third quarter. That's just increasing investors' equity and percentage of ownership in the company. And in addition to that, for next year, they've reported a pretty nice outlook, continuing to grow double digits on the top line, and then really nice growth on the bottom line and with share buybacks as well. So they're kind of swinging on all cylinders here. With that being said, super expensive stock. Lots of this is priced in. Even if they did the high estimate of $15 a share next year, they'd be trading at about $33, $34 a share, 34 times PE a share. If I add the extra dollar in, they'd be trading even higher than that in terms of just the average estimate versus the high side estimate. So you're definitely paying up for this stock versus other clothing brands. Even very good clothing brands like Nike, which is one of their competitors, does not trade at this kind of multiple. So great growth story. They've been able to, similar to Chipotle, prove investors year in, year out that they can continue to grow at a very high elevated level despite being at a high PE to start with. But this is one that you're definitely paying up for the story and the track record of performance that they've been able to dish out over the last 5 years, up 300% on this one. Next stock here is Carnival Cruise Line. Carnival Cruise Line up 135% this year. Similar to some of these other names, this one has had a wild ride, never really regained where it was pre-COVID. They also issued a lot of debt, a lot of new shares throughout COVID. So it's really hard to do an apples to apples comparable pre versus post pandemic here. But trading at about $19 a share, which is a double up on the year. And at the end of the day, lots of people thought that cruise lines, as the consumer may have gotten a bit weaker, as maybe travel demand was dwindling, would get hammered. But, at the end of the day, it seems like lots of these types of entertainment and traveling, especially with their target demographic, continues to remain in high demand, as you see in this article here from halfway through the year. And that has not slowed down as the year has gone on. And what's really great about Carnival, after years and years of losses and then a couple years of them just kind of breaking even, like in 2022, they're actually expecting to do almost $1 a share in EPS this year, which would put them at about an 18 times trailing PE. And then next year, they're looking at $1.30, which would put them closer to 14-ish times next year's PE. So they're getting back to somewhat a reasonable PE after years and years of not really having the earnings to justify a price to earnings at all. These are still, not exactly my cup of tea right now. I think there's a lot of risk in them. They have a lot of debt. I really would need to see them really prove themselves over a number of years to consider, ever investing in this segment of travel. And even at that, I feel like there's lots of other more diversified options, even like an Expedia and Airbnb, that isn't as relied upon certain things in terms of the exact target demo that cruise companies go after, as well as like we just saw how a pandemic completely destroyed their business. The high fixed cost business like this, being not able to serve customers or get revenue for 6 months, 12 months. If it wasn't for incremental debt they took on, special investors, maybe some government support in some cases, they would not have been able to stave off bankruptcy. So that just kind of opened my eyes to the vulnerabilities in the business model and the type of business that they operate, even though it does have some pros as well. Nice to see them finally kind of return to a PE stage, though, with them actually realizing some earnings per share. Next stock here, and there's lots of tech stocks on this list because tech just flew this year, but Alphabet or Google up almost 60% on the year as well to about $1.8 trillion. Despite at the beginning of the year, the stock really selling off at the end of 22 into 23 behind the narrative that Microsoft was going to displace Google on search. Microsoft was leaps and bounds ahead of Google on AI. They really slowly proved themselves throughout the year to, one, be able to continue to post really strong results on their search business, two, finally turn Google Cloud to a profit, even though slight profit in the grand scheme of things, and then three, that they were not that far behind on AI. Lots of the releases, especially the second half of the year, really gave investors pause for that narrative that Microsoft was so far ahead of Google, and Google kind of backed up that they've been working on AI a long time for themselves as well. So the stock got bid back up closer to where it probably deserved to be. Going into the next stock here, this stock had an absolutely unbelievable year. I think the highest percent gain on this list, Affirm Holdings. Affirm, if you look at the 5-year chart, this stock was over $150 in November of 2021 here, right in the midst of the pandemic, and then went all the way down to under $10 a share. This year jumped to $50 a share, so about a 5xer this year to $15 billion market cap. Obviously, for those of you who don't know, Affirm is a buy now, pay later financing company. Looking at some of their partnerships, they've increased their partnerships with lots of vendors, whether that be Walmart, which was a big one they reported late in the year. They also have, I believe, something with Amazon as well as Peloton and other vendors. And once in a lifetime jump. You can see here, Affirm Stock quintupled this year, beating all tech peers on buy now, pay later boom. You can see one of the things we just talked about. Affirm investors bullish on partnerships with Amazon, Walmart's, incremental retailers as well. And you can kind of look at the fact that they outperformed every single company valued over $5 billion in the tech sector this year. So definitely a monumental year for them. Personally, looking at their earnings per share estimate, still expected to lose about $2.7 a share next year. You're thinking they have this Amazon partnership, they have this Walmart partnership, they're gaining that scale, they have to become profitable off of this, right? No, still losing $2 a share, not even close to profitability next year. So I just don't really understand the fundamentals of buy now, pay later, especially with interest rates going up. I just don't get the business model. I don't get how you can really make money by giving people a buy now, pay later service and pay 5% interest yourself to give them that service, even if you're charging the retailer a percentage to do it, and still come out ahead on a margin standpoint, even before any credit losses, even before fixed costs, SG&A, debt service charges. So I just don't fundamentally understand the business model. So it's a space that I'm staying far away from. But investors who were in this one this year definitely had a really great outcome with this 500% gain. So congrats to them. Next up, earlier we were talking about how Google had a huge jump this year behind AI and some of the other things we talked about. Microsoft, who is kind of the first one out of these big tech companies to make a big splash into the AI narrative, up 55% this year as well. So they also continue to ride that wave. It wasn't necessarily Google stole part of the pie from Microsoft. The entire pie just exploded. And we can see that here with Microsoft up 55% on the year. Sure, the rest of their business did great, but there's tons of multiple expansion here because of the AI rollouts they've made across their business, their increased presence with OpenAI as well. Looking here, you can see after a year of the hype cycle, Copilot corporate spending boom is just getting started. So they're continuing to see their recurring revenue accelerate on the products that they're selling, and just the hype around needing to have artificial intelligence in these business intelligence tools and business software tools that Microsoft's selling in Office 365 or Bing or whatever else is being more and more seen as essential, and different clients are paying up for it. So that's really what helped drive Microsoft up 55%. And these aren't small cap, medium cap stocks. That 55% is a couple $1 billion. 55% on this name would have been almost $1 trillion on the year, or maybe even more. My math's a bit down here, but it would have been a huge sum of value being created in Microsoft this year. Next up, still on the AI trend, Nvidia here. Nvidia up another 240% to $1.2 trillion, trading at a trailing 65 PE. Taking a look at this one here, they just made tons of money on AI chips. The title of this article here, you can see Nvidia made $6 billion in pure profit over the AI boom. The company raked in $13.5 billion in revenue since May. It revealed in its Q2 2024 earnings unprecedented demand for generative AI chips, blowing past any difficulty it might have had in more desktop struggles and shrinking PC industry. So you can see just how big AI is just grown for this company, masking all other issues they have on their business potentially. Generative AI breakout year produced hefty profits for Nvidia. There's a couple sound bites in here that were really, really interesting as well that I'm just trying to get to. But essentially, it was just saying how much money that they've been able to make out of AI and how it's just going to grow. You can see here the first 3 quarters into 2023, Nvidia generated almost $18 billion in income. That's up more than 600% from a year earlier. So huge value creation and both value creation from an absolute profit dollar standpoint, but also from a trading multiple. This one has just compounded on both of those fronts to have unbelievable growth, 250% on the year. Over the last 5 years, you can see this one's up about 14 times. So investors who have bought the stock at pretty much any point have done extremely well on it, even though it trades at an expensive price to earnings. Similar trend with lots of these names, whether it's the big tech stocks, Nvidia, Chipotle, Lululemon. Lots of these stocks came into the year trading very expensive and just continue to trade very expensive, even more expensive at the end of the year with the years that they've had. And the last stock that we have here is Coinbase. Obviously, Bitcoin has absolutely run up, I think about 150% up on the year. Coinbase up almost 500%, challenging Affirm for that best stock performance on the year for sure here. Taking a look at this article here, it's just talking about how much gains the Bitcoin run has made in some stocks. Coinbase is obviously the main one, but other ones like Grayscale, Bitcoin Trust, MicroStrategy also benefiting as kind of proxies for investing in the cryptocurrency instead of owning Bitcoin as a commodity or as an asset itself. And then one of the things just worth noting here, we're looking at Affirm, seeing how they lose tons of money on their run up. One of the things about Coinbase here, super cyclical business, super volatile. They're cranking out tons of EPS during the pandemic and the crypto boom last time around. And then they started losing money per share, but they've kind of got back to a point where the business is break even. I'm not close enough to the business to know if they're spending lots in CapEx, reinvesting for future growth, or if they're just kind of scaving out a break-even business at this point, and they don't really have great growth prospects ahead of them. All I know is obviously when volatility around crypto goes up, when more and more people are buying and selling Bitcoin and other cryptocurrencies, Coinbase benefits in a massive way. And that's literally what the stock does. That's what the bet is, the big bet on this name. And, you know, it's definitely something that probably traded around more than a long-term hold for most investors, just projecting whether or not there's going to be a crypto boom or a crash or whatnot. But definitely people who've played around with this one this year have done pretty well, up almost 500%. So those are 10 stocks in the market this year that have just crushed it. Hopefully you guys had some of these on your list, and let me know in the comments if you're planning on adding any onto your list for next year, if you think they can repeat again. If you like this kind of content, be sure to give this video a big like. It really does help with the YouTube algorithm. Thank you guys for watching to the end of the video, and hope you have a happy new year. Bye.